break-even point. The break-even point for any bull put spread at expiration can be calculated in advance as above $62, you could expect a profit, and below $62, you could expect to see at least a partial loss, assuming that all options are worth their intrinsic values as they expire. A bull put spread is considered a moderately bullish strategy, primarily because your upside profit potential is limited. The theoretical maximum profit for any bull put spread at expiration is limited to the credit received when the spread was originally sold, no matter how high the underlying stock increases in price. The maximum profit will happen if the stock closes above the higher strike price and both options expire out of the money with no value. We would like to thank you for taking the time to watch the videos that we have put together for you today. Take a look and subscribe to our YouTube channel, our Instagram, our Facebook page, and reach out if you have additional questions. We would love to hear from you. Check out our website for more information. Go to www.optiontradersnetwork.com. Thanks so much.